The impact of Basel III on asset-liability management. Introduction. In the world of banking and finance, regulatory frameworks play a crucial role in maintaining the stability and integrity of the global financial system. Among these frameworks, Basel III stands out as a comprehensive set of reform measures designed to improve the regulation, supervision, and risk management within the banking sector. Today, we're diving deep into how Basel III has reshaped the landscape of asset-liability management, ALM, a critical component in the banking world. Understanding Basel III. Basel III is a global regulatory standard on bank capital adequacy, stress testing, and market liquidity risk. Introduced in response to the shortcomings revealed by the global financial crisis of 2008, Basel III aims to strengthen bank capital requirements by increasing bank liquidity and decreasing bank leverage. The impact on asset-liability management. Asset-liability management, ALM, involves the strategic management of a bank's assets and liabilities to maximize earnings while maintaining a firm's liquidity and capital adequacy. Basel III has significantly influenced ALM strategies through the following key areas. Enhanced liquidity requirements. Basel III introduced two primary liquidity ratios, the Liquidity Coverage Ratio, LCR, and the Net Stable Funding Ratio, NSFR. The LCR requires banks to hold a sufficient reserve of high-quality liquid assets, HQLA, to cover net cash outflows for a 30-day stress period, directly impacting how assets are managed. The NSFR mandates a minimum acceptable amount of stable funding based on the liquidity characteristics of the bank's assets and activities over a one-year horizon, influencing both assets and liabilities management to ensure longer-term funding stability. Implications for ALM. Stricter capital requirements. Banks need to reassess the composition of their asset portfolios, giving precedence to higher liquidity assets, which, while safer, may yield lower returns. ALM strategies have had to evolve to ensure that the maturity profiles of assets and liabilities are aligned to meet the stringent requirements for stable funding. Basel III has raised the quality and quantity of the capital base banks must hold, introducing stricter leverage ratios and buffers, like the capital conservation buffer and the countercyclical buffer. These measures aim to ensure that banks maintain a strong capital base to absorb losses during periods of financial and economic stress. Implications for ALM. Enhanced risk management. The need for higher capital adequacy has led banks to adjust their balance sheets, often by reducing their reliance on debt, thus affecting the liabilities management side of ALM. Investment strategies have been recalibrated to prioritize not only returns, but also the weight of assets in the bank's capital ratio calculations, affecting asset management. Basel III emphasizes the importance of better risk management practices, including more robust stress testing and risk assessment procedures. Banks are now required to conduct more detailed and frequent analyses of risk exposures across their assets and liabilities. Implications for ALM. There is an increased focus on integrating ALM processes with broader risk management frameworks within banks, ensuring a holistic view of risks and compliance. Conclusion. The introduction and implementation of Basel III have significantly impacted the practices of asset-liability management within banks. By necessitating higher liquidity, strengthened capital bases, and improved risk management practices, Basel III has not only aimed to increase the resilience of individual banking institutions, but also to fortify the global banking system as a whole. As banks continue to adapt to these changes, the evolution of ALM strategies remains a key factor in maintaining financial stability and promoting sustainable economic growth. Want to learn more? Claire Trifle on LinkedIn